My name is Jiayue Zhang. So I'm a third-year PhD student at the University of Waterloo on the supervisors of Tony very gentle supports and the late Kinsey time. So on behalf of Tony, I will present some aspects of green finance about the concepts and the method today because Tony has a serious cold, so sorry about that. Okay, so this is our outline today. So I will give a brief introduction of our talk, and we just from the simple portfolio solution from mean variance allocation, and then we will go beyond the simple extension to the more complex form. So here I will introduce what is heterogeneity in ESG rating, and we will post several proposed strategy. And finally, I will give a brief description of what is ESG related portfolio using mean variance criteria. And finally, the empirical analysis and the conclusion will be provided. Okay, so in this talk, I will focus narrowly on a particular quantitative aspect of green finance. As we all know, this is also called the sustainable finance. And I will provide a highlight selected review on studies which integrate sustainable criteria into a complex portfolio optimization. So I will from the simple portfolio allocation, and then I will extend to the more complex optimization scheme. So here I will include the confusion of the ES rating, and I will try to deal with this kind of thing. So ESG, as we all know, this stands for the environmental, social, and governance. So it's really a popular score. And so firstly, let me talk about the simple portfolio solution from mean variance allocation. So ESG score are well suited for portfolio integration, and there are so many studies focusing on ESG score these days, right? So we have two examples from Tony's previous students here. They just do some portfolio solution from mean variance allocation. So let's see the two examples. So first example is from Tao and Tony very gentle. So they just integrate ESG score into a portfolio construction, and similar to the Markowitz optimization program. They use a multiple objective optimization technique, we just call it MOO technique, to deal with the multiple objective function. So that means maximum the expected return of the portfolio and the minimum the variance of the expected return. And they just put into explicit optimization framework with several strategies, actually 6 strategies, used by investors wishing to incorporate ESG score. And their conclusion is the thematic investing performed the best in their experiment, and they show that there's no evidence that ESG portfolio underperformed the market. So that's the first example. So the second example is from Wang and very gentle. So they focus on ESG integration within portfolios by promoting a general quantitative strategy. So in this idea is just using a resampling technique. They just resampling from positive and negative ESG constraints. So that means the green and the brown companies on the standard mean variance portfolio optimization. So that's portfolio optimization leads to improve the investment performance, and it also help to efficiently estimate the vector and the covariance factors of the expected return of the portfolio. Yeah, so that's just a 2 example for the simple portfolio solution. So as we all observed, in this stream of literature, the portfolio optimization often takes place with a single source of ESG rating. That means they may only select one source of ESG rater, for example, MSCI or ISET for something. But there is a huge or active disagreement on the ESG rating of companies by different ESG rating agencies. So that's what me and Tony's work. So so that's will lead to a widespread aggregation confusion of ESG rating, because when the sustainable investor wants to do the investment, they may feel very confused because they don't know which ESG score they should use, right? And the conclusions are really different. So That is we call heterogeneity in ESG rating, and it's also our motivation for this research. So we just find this motivation by tracking the sample correlation for the 4 pairs of ESG rating. We just select the data from Sustainalytics, Robeco-Sun, Asset4, and MSCI for 2 years. So the table is shown here. So we can see from this table, the higher is the correlation coefficient, it's only 0.5. It's pretty low, I think, right? And also we can observe that there are several negative correlation coefficients. So that means they are really different, right? So the low correlation leads to an outstanding issue of the aggregating ESG confusion, like what I said before. Okay, so next we will introduce what we call ESG ambiguity. So usually a traditional sustainable investor has a single view of a company's ESG score. They only maybe regard one company's ESG score maybe at 80, 85, or 90 something. But in practice, when they want to doing some decision making, they may find they have so many different views of the ESG score. So the outstanding heterogeneity of ESG ranking of companies by those different ESG raters lead to the investors' ambiguity with respect to the ESG rating. Okay, so here we don't mean that the ESG rater is not useful, or we not judge that ESG raters make wrong decision, because different ESG raters focus on different parts. Maybe for focus more on the environmental, focus more on the social or the governance, right? So they have different standards. So that's caused the difference in the ESG raters. So instead of just finding an optimal universe ESG representative in any given time period, we just provide several strategies to assemble ESG score based on the investors' preferences. So when the investors want to doing some investment, doing some trading, they may feel confused. So here we can provide several strategies for them. So first one is we call the clustering centroid. So usually a centroid is a center point of the group. We're using the Euclidean distance to measure the dissimilarity of the different data set of the different data point. So after simplifying the objective function, the centroid reduced to the simple mean. The simple mean. So the centroid just using as if you want to take all of the information into your consideration, you can use just a lazy way, just using a simple mean. And the median, for the median, median is really resistant for the extreme value or outliers. So if the views are really different from each other, maybe the median is more robust or more reliable. And third one is PCA. PCA can reveal the most important variable or the dimension and capture the majority of the variation in the data without losing much information. So PCA is also a method if you want to consider. And the fourth one is alpha max mean. So that one is from the concept of ambiguity. So that is different from median, because for alpha max mean, this is a formula. The infimum excitation is for the worst case, and the supremum is for the best case. The alpha is just a weight to adjust your opinion of these two things. So that is suitable for the investor who really care about the extreme cases, and they want to build up their view from the extreme cases. So that's really different from median. So we later will use these 4 approaches to generate investment strategies to cater to different investors with different types of the preferences. Okay, so our software is using by the reinforcement learning technique. So this is just a general flowchart of the typical reinforcement learning for finance program, for the finance application. So environment is usually a finance market, and the state is something about the information about the stock, such as the balance, shares, or prices, or something. And the trading agencies is just the algorithm or software to deal with the decision. And the actions is when we make some decisions, we will make maybe sell, hold, or buy the stock. And the reward function, the pink one, is profit or loss. So usually we maximum the profit and minimum the loss. So here, because we want to consider both the classical expected return of the market and also the ESG, portfolio ESG score. So we change our reward function to this kind of the linear combination of the market expected return and also the market ESG score, weighted ESG score. Okay. So we download the data for 50 years and change them to 12 movie window. And our conclusion is shown in this picture. So we can see that the back and forth ranking shows that no single rater can make the portfolio perform the best all the time. So that will cause the investor feel really confused because no one can perform all the best. Okay. So next, we want to construct some theoretical model. We call it as a double mean variance model. So that means we not only consider the market expected return and also the ESG return and also ESG variance. So instead of using the exponential utility, here we use the mean variance framework. So why we use mean variance? So first one is mean variance provide a sharp separation of the model. They can provide a sharp separation of the expected return, risk and ambiguity, and also the risk aversion parameter, right? So most importantly, mean variance preference can be extended to its robust version to account for model ambiguity, which is stated at the Mascheroni 2013.
So about 4 minutes left.
Okay.
Yeah.
Okay. Sorry.
So
So this is our objective function. First part is from the market objective function. It's just a classical one. And also we just using the expected the ESG score and the ESG variance to build up the ESG objective function. And then we combine these two using a parameter B here. So the parameter B stands for the relative taste between pecuniary return and the non-pecuniary return. So that means if B is greater than 1, that means we will put more emphasis on the non-monetary or the non-pecuniary return. Okay. So after taking the first order condition of our optimization program, we will get this kind of weights. And we will write these weights to the formula 6. And we separate the formula 6 to 3 terms. The first term is the benchmark case for the ESG indifference. So because we only consider the classical market information. And the second term is a benchmark case with ESG preference when the ESG profile is known with uncertainty. So because here we didn't consider any variance of ESG score, we only consider the expected value of the ESG of our portfolio. The last term is capture the incremental effects of the ESG ambiguity. Because here we not only consider the sigma square or the variance of the expected return, we also consider the variance of the ESG score. Okay, so next we separate we define 3 types of the investor. First one is the ESG indifference. So those investors are not they didn't consider the ESG score at all. They're just a classical investor. And the second one is ESG preference with no ambiguity. So they will use ESG score, but they will face a clear and fixed ESG score. They only has one source of ESG score. And the third one is ESG preference with ambiguity. So
2 minutes. Yeah.
So here they face several ESG scores. So here is ambiguity. And because the time is limited, so here we just provide several conclusions. So here we just compare the two several pairs of we just see the 3 types of investor, right? So we can find the investors with the ESG investors without ambiguity will have less return than the indifference investor. That's because they are willing to sacrifice some return to getting more greenness or sustainable investment. And the second pair is for if you have higher uncertainty. So the higher uncertainty will be compensated by the higher return. So that's why the formula 11 is greater than 0. And 12 is between the first and the third part. So this is numerically indeterminate because the trade-off between the expected return and the variance of the ESG score. Okay, so here is just the variance relationship. So we will ignore here. And this table shows our derivation of the variance and citation and also Sharpe ratio. And our empirical analysis shows that. So give me only 1 minute, okay? So if we compare this one and this part, because this part just the investors without ambiguity, and this part is with uncertainty or with ambiguity. So we can see the first line is generally greater than the middle part. So that's consistent with our derivation. And the last line we can also see is also greater than the middle part. It's also consistent to our derivation. And if we compare the first one and the last one, because those are numerically indeterminate, so you can see the highest is here or highest is here, so it is indeterminate conclusion. So yeah, it's generally consistent to our derivation. Okay, so that's generally our topic today. So many stuff, so I'm so sorry to delay that. And I think there's much room to be done. And the reference is here. Thank you so much.